This segment is titled Banking Sector Resilience to Extreme Weather Events. And so we've got a similar format as our first panel. We'll hear from our academic moderator, we'll hear from our presenters, and then we'll have a chance to hear from our community bank discussant before we move on to audience Q&A. So with that, I will turn the program over to Ivan Ivanov, senior economist at the Federal Reserve Bank of Chicago, to kick us off.
Thank you very much, Jim. We're going to start with our first paper that is authored by Sean Ann, who is the Federal Reserve Bank of Philadelphia. And the title of the paper is Extreme Wildfires, Distant Air Pollution, and Household Financial Health. Please, Sean.
All right, thank you, Ivan. Good afternoon, everyone. I'd like to thank the organizers for having me. I'd also like to thank my boss, head of supervision at Philly Fed, Bill Spaniel, who's here today with us. Bill has been very supportive of our research and analytical work, but more importantly, Bill has the vision of and provides the support to making Philly Fed a hub of data management. A lot of the data we use in our research, including some of those in this paper, is not possible without Bill's vision and support. So thank you, Bill. Well, the work I'm going to present today is joint work with Stuart, Gabriel, and Nissan Ilan. The standard disclaimer applies here, so these are our views, not the views of the Fed. Well, you all probably have read about the fire in Maui. Now, how many of you have breathed the smoke from Canada? All right. It was pretty bad, right? Well, my wife and I actually had to get an air purifier to cope with it. Well, this is concerning also because wildfires are now becoming more and more frequent. So my co-authors and I wanted to understand how wildfire and wildfire smoke affect our communities and households. Well, due to the amount of data effort that's needed, in the current study, we only focus on the 4 extreme wildfires in California. From the very top, all right, going clockwise, so the Carr Fire, the Camp Fire, the Thomas Fire, and the Central L and U Fire. The Camp Fire north of Sacramento, that one pretty much wiped out the whole town of Paradise. I'm sure you read about it. Now, let me use this figure here to explain a little bit of our strategy to identify the impact of fire. Well, this is for the campfire. The red indicates the fire burn area. The orange are areas that are 1 to 5 miles away from the fire boundary. All right. So we have the red, so that's the burn area, and the orange that's not affected directly by the fire. Right? The idea here is to compare the red and the orange, so the burned and non-burned areas. Of course, we adopt some of the state-of-the-art techniques, the difference in differences analysis, and in order to also to avoid complication due to spillover effect, we carve out the purple one, which are immediately adjacent to the fire. All right. So with that, let me just quickly show you some results. First of all, without surprise, we see that wildfire, specifically in this case, the campfire, had a pretty big impact on net migration, mainly due to people moving out of the area. And then on housing, we also have found pretty strong effects along a number of dimensions on housing. For example, house price, number of housing sales, and occupancy. So for example, on house price, right, these are quarterly estimates. So if you look at the effect, it's about 7%, an adverse impact. So it causing a house price decline of 7% per quarter for a number of quarters, right? So these are pretty significant effects. Well, forgot to mention that our estimation on housing impact and on migration, that's based on relatively large geography, census tracts. Next, we utilize our rich data we have at FiliFed to look at consumer level outcomes. So here, for example, here we look at consumer credit performance, credit delinquencies, right? Here again, we see some adverse impact on credit performance, especially for credit cards and store cards. So wildfire caused the credit cards and store cards delinquencies to go up. Well, to better understand the delinquency results, well, we further leverage our Federal Reserve collection of credit card data from large banks. These are longitudinal data on individual credit card accounts. We have a lot of detailed information such as the spending, the repayment, balance, number of days past due every month. All right? With that, we're able to look at what happened to consumers who were exposed or affected by the campfire. What happened to their spending? What happened to their repayments? On the left-hand side panel, you can see a clear effect on spending. So that's without surprise, right? People had to spend money to cope with the adverse impact of wildfire. Now, on the right-hand side, this is surprising. So we see associated with the campfire, consumers actually repaid faster. And if you look at the magnitude, it's actually slightly bigger than the increase in spending. Right? So why? Well, what happened? And especially connecting this to the previous results on delinquency. Now, why do we see delinquencies when people repaid their credit card debt faster than they spend? Right? For quite a while, my co-authors and I couldn't understand it until we separate households into homeowners and renters. Right? The story here becomes a little clearer. Now, if you look at this, we have 4 panels. The left-hand 2 panels are for homeowners, all right? And then on the right-hand side, those are for renters. Now, you see here the balance reduction or repayment effect really comes from homeowners. Right? And then on the right-hand side, you can see the delinquency effects really comes from renters. And our interpretation here is that this has a lot to do with insurance and insurance payout. All right? When homeowners, when their properties got damaged by the fire, they could file insurance claims to get a big amount of payout. So they could use that money to pay down some of their debt, including credit cards. Actually, a recent paper by some colleagues in my group showed that actually in California, after a wildfire, there's some evidence that people actually used insurance payouts to pay down their mortgage loans. And then Justin here today has a great paper also showing some evidence that after Hurricane Harvey, people used flood insurance payout to pay down their mortgage loans. So we think here is a similar phenomenon. So for homeowners, right, they can do that. Now for renters, usually they don't get much out of insurance payout. So if they had to spend extra money to cope with the adverse impact of wildfire, then they're more likely to fall into delinquency. Now, that's enough about the wildfire itself. Now, what about smoke? All right, so again, for the sake of time, let me skip 2 slides and show you directly some results. All right, first of all, this is on credit delinquency. Again, we look at the same outcomes, mortgage delinquency, credit card delinquency, personal loan, and store card delinquencies. Now, here we see not only wildfire, but also wildfire smoke had some negative impact on credit performance, as evidenced in the increase in credit delinquency after fire. Now, we also, again, look at spending and repayment using our Federal Reserve collection of credit card data. Now, on the left-hand side, again, you see increase in spending, right? Well, about 1/3 of Americans have someone in the house who has respiratory issues, such as asthma, right? You can imagine people had to spend money to deal with health issues. Also, getting back to what I said at the beginning, right? Air purifiers, other preventive measures, right? So that can be reflected in the increase in spending. Now, on the right-hand side, this time is different, right? Recall that the fire effect is that there's an increase in repayment, but this time we see a decrease in repayment. Again, this gets back to the insurance story. For direct wildfire, right, if your house is damaged, you can get insurance payout. But if you're distant from the fire, you are affected by the smoke, then it's not likely you're going to get insurance payout. So for people who have to spend money on medical or on preventive measures, they probably have to pay back less. In fact, we dig a little deeper into this. We segment our consumers, credit card borrowers, by their credit score. Now here, again, some interesting patterns here. So we see the increase in spending is more evidenced among borrowers with higher credit scores. All right. So these are people usually with higher income, higher liquidity, so they probably could afford to spend more using their credit card more to take preventive measures. And then the reduction in repayment is more evidenced among borrowers with lower credit scores. So these are usually lower income people with less liquidity, right? So with the fixed amount of money they are taking in every month, if they have to spend more to cope with the effect from wildfire smoke, they probably had to repay less on their credit cards, right? So those are all the results. Now let me quickly summarize. So out-migration as well as declines in house values are evidence in wildfire burn area. Higher levels of financial distress is seen among burn area renters, especially those with lower credit scores, while the fire effects on homeowners are less salient, possibly due to insurance coverage. Now, one of the implications here could be, well, given the importance of insurance as a safeguard to households, to mortgage holders, lenders, including community banks, it's important for them to make sure insurance is in place. In fact, we have seen some numbers. Insurance take-up rate is low, is worrisome. So for example, for flood insurance, even just among those who live in the floodplain, only about 50 to 60% of those people have flood insurance. Now for fire insurance, we know the premium has gone up and some insurers have already put out of the market. So that could also be challenging. But again, back to my point, for lenders, it's important for them to make sure insurance is in place. Right? Of course, we also need to think more about renters, not just homeowners. Well, finally, there's smoke effect. All right. Let me end my presentation with some quotes from a research article written by our former first Vice President Jim Narron, called 1816, the year without a summer. All right. I will let you read it, but I think this tells us how far smoke can travel and how widespread effect smoke can have on households and on our economy. All right, thanks.
Thank you, Sean.